What's up everyone, it's Karthik with MoneyVest. Welcome on board for our Market Open live stream here on Monday morning. I'm wearing my red t-shirt because of the amazing gap down that we're seeing in this market after the US downgrade from Moody's on Friday. We talked a lot about this over the weekend. The Treasury yields, so the 10-year Treasuries are moving back over 4.5%, and the 30-year Treasuries are pumping back over 5% right now. So this is a clear indication of a slight risk that the markets are seeing from the US debt standpoint. So that's the reaction, 2.6% higher on the 30-year Treasuries. And of course, the 10-year Treasuries are also seeing a little bit of a lift right now of 2.5%. So Treasury yields across the board are rising. Short-term and long-term yields are all moving higher. And as a result, we are seeing the markets right now, as it stands, pre-market are a little bit lower. QQQ is down over 1.3%. We've got S&P 500 down almost 1%. And of course, a lot of individual stocks, including the likes of Tesla down over 3.7%. Nvidia is down over 2%. And the list goes on. And volatility here is slightly higher, up over 12%, but still trading under 20. So welcome on board, everyone. Thank you so much for joining. Good morning. Good morning. Make sure that you are dropping a like and of course subscribe if you haven't already. Shane says morning really isn't looking that bad. Slight is a keyword. Yes, it's not really that bad. I mean, considering that you have rallied already, over 25 to 30%, it is really not terrible. I mean, we are trading very close to near all-time highs, and that's one of the reasons I was like thinking about in one of my drives over the weekend. I was like, I don't understand why people are freaking out so much, because I mean, QQQ is already up like, this is the SPY, so up 23, almost 24% from its lows on April 7th. And then you've got QQQs, that are up from its lows of $402, up over 29.5, almost 30% rally in a span of like 4 weeks. So a pullback like this was overdue anyway. So there was a technical rebound expected, technical pullback expected, considering how overbought and overextended we were in this market. So, this is just one of those catalysts kind of sprinkled in, driving the markets lower, and there's nothing wrong with that. However, we just have to be mindful of where we are in this market environment, right? So April 7th, clear buying opportunity. Volatility is at 60. MoneyVest index is at 1.76. Market breadth is extremely oversold, and you've got, the individual stocks, as well as the markets down over 25% from all-time highs. So we are clearly in a bear market. And after this rally, it's the exact opposite, right? So we want to be a little bit more careful and cautious and have more cash ready for any kind of opportunities that come our way once again. So that's really where we are at the moment. So nothing crazy. This is very, very normal in this market circumstance. Now, of course, if you take a look at the Treasury yields, they are obviously pushing higher, which is a sign of concern, because as the yields continue to move up, that is going to create this flight to quality, right? Because yields become more and more attractive, and so capital is going to flow out of equities over to the Treasuries, and then that is going to once again result in more demand and yields coming back down. And that's how flight to quality works. Like if there is a risk-free rate, which is theoretically risk-free, even after the downgrade, we're looking at 4.5%, closer to 5% on the Treasuries on a 30-year basis. Just imagine that 30-year, you're getting a 5% rate of return annually, which is, again, a very strong number, considering that inflation is at 2.5%. So you're netting your real rate of return at 2.5% as well, right, after you account for inflation. For a lot of endowment funds, for pension funds, I mean, that is set. That is really, really good rate of return. But then, of course, for investors who want additional alpha, want to generate something over and above that 5% and 8% that the equity markets offer, then of course you start going up the risk curve, looking at individual stocks, even ETFs, stuff like that. So this is definitely a bit concerning, considering that, after the downgrade, we're seeing the yields push higher. But that still doesn't take away from the attractiveness of equities as of yet. It's not until after it gets up to, let's say, 7, 8, 9% when things start to become incredibly concerning for equities, for stock market. Okay, let's see. Wasn't Trump going to announce some kind of deal back when back from Saudi with this and him tweeting about Moody's? So that was actually fake news. So I removed it from the video as soon as I learned about it within 30 minutes. That was not actually the tweet from Donald Trump. But yes, he did confirm the Saudi investment of $600 billion and multiple trillions from Qatar and, of course, the UAE as well. In my opinion, I think I absolutely loved the trips in the Middle East and the investments that they're making into the U.S. Because they're not playing around, right? They want to do better for their own economies and for their own people. So they want to diversify their economies away from natural gas and oil and petrochemicals. And as a result, they are focusing on that long-term vision of growing their economy by partnering and strengthening their relationships with the U.S. So that's where we are. We'll keep you guys updated with whatever deals come through for other countries as well. But so Ken Sui, isn't Moody's a lagging indicator? Well, we talked about this over the weekend, and it's not like people didn't see this coming, right? I mean, if you consider S&P Global doing the downgrade from 12 years ago, and then you got Fitch doing it in 2023, a couple of years ago. I mean, if I asked you a couple of years ago, do you think that Moody's at some point is going to downgrade the U.S. credit rating? What will be the most likely answer from you? Knowing that, okay, 2 of the 3 major credit rating agencies already downgraded the U.S. Based on the debt levels and the continuing rise of the deficits, what would be the probability of Moody's doing that as well and following the footsteps of the other 2? You would put a very high probability that yes, I mean, I could see Moody's doing that in the next few years and following the footsteps of S&P and Fitch to downgrade the U.S. at some point. So it wasn't like this was out of the blue or this was something that, blindsided investors. It was something that, was expected, was going to happen at some point because the U.S. debt situation, the deficit problem has not improved at all. It's only gotten worse. And we've been talking about this 4 years ago, 5 years ago. I've talked about this in our videos, in our channel, in our Discord, that this is a longer term problem. This is a problem that the U.S. will have to confront at some point because if there is no fiscal discipline, you erode the value of the currency, which is the U.S. dollar, if you continue to print it and buy treasuries. And if there is no faith in the system, then that obviously breaks things down. So this is a more longer term problem. We're talking multiple decade cycles, which takes time to play out. So this is a longer term problem, but short to medium term, what really does matter is, of course, earnings and how are companies doing in this environment. There still needs to be demand for the treasuries, and we have a couple auctions coming up this week. So that's where we are. I mean, this is not anything new. This is something that we were expecting, but markets are obviously reacting to it as treasury yields are pushing up, and of course, markets are rolling over. And technically speaking, also, we were overdue for a bit of a pullback and a dip anyway, considering how overbought we were. So welcome on board, everyone. Thank you so much for joining. And again, if you have any questions, please feel free to ask in the chat. I'm more than happy to go over. I'll be live for another 35 to 40 minutes. May not be live after the market's open because I have to sell some puts. I'm going to be selling some puts on SoFi. We'll possibly be selling some puts on NVIDIA maybe. Because that's the beauty of sitting in cash. Because I did sell my SOXL and my TQQQ, was able to raise my cash exposure back up to 14-15%, considering the volatility was incredibly low. And of course, the MoneyVest index was coming down back over 3.8. So we are in optimistic zone here for the MoneyVest index. And, this is a very, very, very simple breakdown. Like, this is really not to overcomplicate things. What we do here at MoneyVest is, of course, we're buying when the MoneyVest index is really low, and we're not necessarily selling unless it's a trade. So I'm not really touching my long-term investments. So for my long-term portfolio, not really touching any of that. We'll continue to ride out the volatility. But really for trading activities, for options, I am buffering up my cash position, increasing my cash when we get up to these extreme levels. And that's really what it comes down to. There's no complications. There is no misunderstandings. It is very simple process of looking at a couple different high-level indicators because this already accounts for the market breadth, the market thresholds, volatility. Then, of course, you're looking at the RSI, the drawdown percentages. So a lot of different technical indicators built into one single index, as well as looking at, of course, the volatility as well, which was coming down to pretty low readings, 17.2. So we were expecting some kind of a spike in volatility as well. So that's where we are. And again, if you have any questions, let me know. I do want to break down a few things. This is what I mentioned in yesterday at like 1:15 in the morning before going to bed. Some final thoughts going into next week that I wanted to share. So there's a lots of fear on this U.S. credit downgrade, right? So there's a lot of panic and a lot of fear in this market right now. Historically, these downgrades have been proven to be incredible buying opportunities. Markets higher 1 year later, 100% of the times after the two last downgrades. So that's exactly what we mentioned in the weekend video. Now, that being said, markets most likely to gap down on Monday, which is what we're seeing right now. Short-term technical pullback was overdue, considering the overbought technical levels here, right? So RSI, MACD, as I've been talking about all last week, that we were pushing higher. We're kind of hitting those upper limits on the RSI and the MACD. So not predicting, but fully ready for a potential 5 to 7% drawdown if it happens, and even as much as a 10% technical correction given the overbought conditions. So I will be ready with cash to scoop up deals and opportunities if presented once again. This is literally rinsing and repeating the whole process. So if TQQQ is given to me back in the 40s, if SOXL is back in the 9s and 10s, guess what? I will be ready to take that same trade all over again. Long-term investing requires patience, discipline, and execution, so not really doing anything there. Riding out this volatility, as I've always done in the past as well. So not making any crazy decisions there. And I will be looking at selling CSPs. So TLDR is short-term technical correction possible, which creates long-term opportunities for investors. For stocks, I'm ready with cash to buy. With options, I'll be looking at selling some CSPs. So that's where we are in this market environment. And again, like I said, there is 3 cycles. There's a short-term, there's a mid to long-term, and then there's the mega long-term. Short-term pullback expected. Overbought conditions, very normal. Mid to long term, we're talking 1 year out, 2 year out, 3 year out. I expect this catalyst to be a small blip in the overall trajectory. And mega long term, which is the longer economical cycles, that's when this is going to be a bigger problem because the US at some point has to confront the reality, which is this is not a sustainable path. Jerome Powell's talked about it. Warren Buffett's talked about it. Ray Dalio's talked about it. Jamie Dimon's talked about it. I think there's a lot of people. I think even Tom Lee's talked about it. Josh Brown has talked about it. So many people have talked about the level of debt, the national debt, the deficits, and we're clearly not on a path which is sustainable. And if there is any kind of lack of faith in the U.S. credit system, then that's when U.S. Treasury yields start to go up because they're compensating for that higher risk. So that's what happens, right? When there's no demand for bonds, prices plummet, yields go up to compensate for that risk. And when yields get to a point where they're attractive again for the level of risk that market perceives that, okay, this level of risk I'm comfortable with for this level of reward, that's when buyers step back in, scoop up all those bonds, and then prices stabilize and then start going up again. And then we see the yields rolling right back down. So that's the overall chronological way a lot of these things work. Okay, let's see. The occasional detailer, my puts will love this opening. That's great. Love to hear it. NVIDIA today, +1 for UNH update. So I'll talk about UNH briefly. I've mentioned this in our Discord as well. So occasional detailer, when you say 5 to 7% drawdown, are you referring to your portfolio or specific index? So I'm primarily talking about the S&P 500 and the NASDAQ. And again, this is not a prediction, but just saying that, okay, we need to be ready for if there is one because of how much we've moved up, how overbought we currently are. So on this channel, we never like to make predictions, but be prepared. And so one of the quotes I shared in our Discord earlier today is one of the phrases that I keep telling myself. There's a lot of them, but one of them I shared is my edge isn't prediction, it's preparation. And that's how I want everyone to approach the market forever. You're not here to make predictions. You need to be prepared for when the opportunities present themselves based on the risk and reward. You're ready to strike. You're ready to execute. And a lot of the work happens on the back end. It happens, the homework that you do happens in the downtime. It's not happening when the market's open. It's happening when the markets are closed. You're researching, you're analyzing, you're working with your indicators, you're working with your signals, you're refining them, you're backtesting them, and you're putting in a lot of work in the downtime to see what works, and then market open is strictly for execution. So when the opportunities come your way, you're ready to execute because buying windows are not as long as selling windows, right? So buying windows are pretty short, because if you come back over to volatility, for how long did we actually see the VIX at over 60? Not even a full day, because it got up to over 60 and then it immediately came back down. The following day, the high was 57, 58, so never saw that again. The following day, absolutely got crushed 35%, and then the rest is history, right? Essentially, slowly and steadily made our way lower, down 60, 70%. So people who take advantage here in those 2 to 3 day window are also the ones who did a lot of homework prior to the spike in volatility, and of course were able to execute and also had the cash ready to deploy. People who didn't have any money here were already in margin, couldn't do anything. Literally couldn't do anything. If anything, they were forced to sell to the people that were ready to buy. So that's when transactions happen. That's when the most money is made, is in preparation. In preparation. That's what is the most important. Okay, let's see. 30-year Treasury is about 5%. Last time it was in 2006, 2007. Actually, no, it was not in 06, 07. Does anybody want to tell me when was the last time it was actually above 5%? The 30-year Treasury? Because I can already go back and tell you exactly when the last time it was up at over 5%. It was in October 2023, so it was like a couple of years ago. So it was not in 06, 07. It was literally a couple of years ago in October 2023 when we were trading at over 5%. We actually got up to as much as 5.177, so almost at 5.2%. So no, it was not in 06, 07, but rather in October of 2023, before, of course, crashing right back down to 3.9, just under 4%. So crawling, so are you not buying any stocks today, only puts? Yeah, most likely we'll be selling some puts, because the thing is that with selling puts, what it allows me to do is pick a strike which is actually lower than the current market price. So if the market sees this as a persistent catalyst to move lower, and then you combine the technicality of the market, which is overbought conditions and, RSI at very overbought levels, that gives me the opportunity to not buy at the current market price, but rather at a lower price, which will allow for the markets to pull back even more. So selling CSPs is a great way, in my opinion, to accumulate more shares at your desired strike price. So that allows me to wait and collect premiums while the prices come down to my desired buy targets. If they don't, that's okay. I collect the premium. I keep the premium. That's increasing my cash exposure anyway. If it does, I am able to accumulate at better prices. So that's what I will do. The only time when I'm like very aggressive in buying straight up stock is when the risk reward is extremely good, right? The risk reward is so favorable that I don't want to wait to get assigned on my puts, because then I have the risk of waiting for a permanent loss of opportunity, right? So for example, QQQs came all the way down here. If at 411, 410, right? I'm selling puts in the 390s, 394, 395. And then guess what happens? 30% rally in the NASDAQ over the course of 4 weeks. I make my premium, which is small, but I miss out on that entire opportunity. So in times like these, right, when the risk reward is extremely good, you've got a volatility at over 60, you want to be aggressive and you want to act quick, and you want to be dollar cost averaging as aggressively as possible, right? Come up with the cash to take advantage of that. And of course, when times are like these, when we are already at overbought levels and we have a lot of downside, potential downside, there's a lot of risk involved, then selling puts, in my opinion, is a better way, because then you are allowing the markets to breathe a little bit, come down even more if it needs to, at your desired price. And if it doesn't, you're already pretty happy with the premium there. Okay, I'm late. Did I miss anything important, Jeremy? I think a lot of things. We've been live for about 19 minutes. Lots of important nuggets of information. No, I'm just kidding. You didn't miss anything important. We're just taking a look at the markets, talked about the US downgrade, talked about the treasuries, talked about volatility, talked about different psychological things to focus on when markets are acting erratic, and when to actually act and when to sit tight and do nothing. Vault. Hi, Karthik. Do you think this Moody's included sell-off is going to be as shallow or similar to other downgrade sell-offs, 10% in the next 30 to 50 days? So one of the things I do want to point out is that there is some small misunderstanding from the past downgrades as well. Because, a lot of folks think that this downgrade was the only reason and the market sold off 10 to 15% last couple times. But that's not actually correct. We had a government standoff back in 2011, and then we were literally coming off of the great financial crisis. So there were a lot of scars from the Great Recession of 07-08. Markets didn't really recover all the way back to all-time highs in 2011. So we were way off the highs, and there were other factors. In 2023, once again, you'll notice that we were dealing with inflation. We were dealing with interest rates. There was a lot of other factors at play that resulted in the markets to be more volatile and be more erratic, moving higher and lower. And of course, we dropped 10%. So this one catalyst, pinning the 10% sell-off last couple times to this one catalyst can be misleading because there's a lot of variables at play. This cannot be and is not the only reason why the markets are selling off, right? There's other factors involved. And just like last time, this year, right now, in this moment, there's tariffs. Again, there's interest rates. There's inflation. There is a lot of politically driven news with a lot of these deals that are happening that is also driving the market. So it's not the only reason, but it's one of the reasons. So we have to be careful in understanding that. Even in the past, there's been other reasons that resulted in the markets rolling over. What do you look for when start buying 3x or stocks, VIX more than 30? So ideally over 50 or 60. That's when leveraged positions is what I would be going into. Similar to what we took for trades for TQQQ and SOXL. We have our volatility spreadsheet. So I keep tracks of where we are in the VIX summary. So right now you'll notice that we're very normal, 1950. That's where we're at. So we're very normal right now. And it's not until after we get up to, let's say, 40. I would say 40 because then we're in the 98th percentile. And days above 40 is 204, which is less than 3% of the times. So, when you are aggressive with the buying and dollar cost averaging, what you're really trying to capture is the rarity of this event, right? Because how you act during those 1% of the times, is what's going to dictate those 90% of your results, right? And that's with anything in life, right? What you do, and a simple example I can give you is, when everyone says, okay, I worked 8 hours a day, or I worked 10 hours or 12 hours a day, but in reality, when we talk about deep focused work, it's usually only a few hours. Only a few hours when we have all our distractions set aside and we're putting in our deep focused work, either at your job or at your business or wherever it is you're working. When your deep focused work is going to be few hours in a span of, let's say, 12 or 16 hour day, that's a very small percentage, but that's going to be the reason why majority of our results are going to be accounted for, right? That small, deep focus work is accounting for the majority of your results. Same thing with investing and trading is the decisions you make during those 1% of the times when the markets are giving you the best deals and discounts is what's going to dictate the 90% of your results. Because if you think about it, it's very easy to buy on the way up. It's very easy when things are going well. When everything is green, when every stock is pushing higher every single day, we're seeing a lot of momentum, everything's pushing up, everything's flying. That's the easy thing to do. Even for newer investors, it's very easy to buy when things are working out. But it's the 1% of the times when things don't work out, what you do then is what's really going to dictate your results. So hopefully that gives you a bit of an idea. So what we're trying to capture, Nikki, is the rarity of those events. And we track them by looking at volatility. We track them by looking at the market breadth, the MoneyVest index, the RSI readings, the drawdown percentages, the valuation of the entire market on an aggregate basis. So all those things put together gives you a bit of a sense of the risk reward. And is this something worth acting on, or is it something to be kind of waiting for better opportunities? And it really comes down to risk and reward. That's all it is. Like, I can literally summarize my entire way of thinking in risk and rewards. That's all I think about. Palo Alto Networks valuation today. So it is high. I think I've got this stock also as part of my shopping list. By the way, in our Discord, someone mentioned that when the markets were down on April 7th, significantly in a bear market, 80% of my shopping list was triggering those buy targets, 80%. So if I've got 37 stocks, let me just do that quickly, 37 times 0.8, we've got almost 30 names, 30 stocks that were hitting those buy targets across the board. Light buys, heavy buys, fair values, no-brainer buy targets. They were hitting them. And so all of them, of course, have pushed up from those levels. So this is Palo Alto Network, April 4th. It was down at 143. It's now moved up over 34%, back up to 191. But yes, valuation is expensive, in my opinion, for Palo Alto. So for long-term investment, do you time your buying or you buy at particular time regardless of the market conditions? So there's a difference between like long-term ETF and index investing versus individual stocks, because valuations matter significantly more, in my opinion, for individual stocks than they do for aggregate indexes. And I've run this experiment many times in the past. We've done studies on this. We've got Excel spreadsheets that I can show you. But in reality, index investing, I've bought at the worst possible times on purpose when money invest index was, like, let's say, euphoria, right? Absolute greed in the market. Volatility is extremely low. Markets are at an all-time high, very overbought conditions. And that's when I would go in and buy VUG. I've done this experiment for multiple years. And guess what? Despite me buying at the worst possible times, I came out on top. Like I'm up like 37 or close to 40% now on my VUG position. So with index ETFs, I was able to conclude after my learning that, okay, despite the market conditions, dollar cost averaging will win out over the long term because I'm buying at the best times, I'm buying at the worst times, I'm buying more at the best times. So over time, dollar cost averaging wins out, every single time. So with ETFs and index funds, it matters less. It still does matter, but it matters a lot less. But individual stocks, absolutely. You want to be very, very understanding, focused on what you're buying, cash flows, earnings, balance sheets, valuations, all that really matters because that's really what's going to dictate how the performance of that company is going to do. Vault, good history lesson. Karthik, thanks. Indeed, there were other reasons, but looking at current situation, do you think market will care about this downgrade? Moody's is late to the debt crisis party. I think it's possible, but I do think one of the biggest risks for the market was tariffs. Tariffs was, in my opinion, 10 times bigger than this Moody's downgrade, because that actually could have had immediate and lasting impacts on how companies do business, right? So if you look at tariffs as being a bigger catalyst for this market drawdown, and we already went through that entire cycle of the markets rolling over and then pushing right back up, then I don't expect the Moody's downgrade to be a bigger catalyst than tariffs was. Because like I said, tariffs had an immediate impact. They were like in effect immediately affecting companies, and that was going to be affecting the earnings. Moody's downgrade affects the credit markets more than it does the equity market. And we're seeing a little bit of that impact with the Treasury yields pushing higher. But similar to what we've seen in the last couple of times, it's proven to be a nothing burger over 1 year later, 2 year later periods. So John says, Moody, USA went from a 5-star Michelin Red Star restaurant to a 4-star. People still love a 4-star restaurant. That's a great way to put it, but I wouldn't say it's gone from 5-star to 4-star. I would say from let's say a 7-star Michelin restaurant, it's gone to like a 6.9. So it's not a perfect 7 now, it's like 6.9. So because you have to think about it in relative terms, this is a 21-notch rating scale. 21-notch rating scale. And we just went down 1 notch. We're still in the investment grade, still in high grade. US is still the reserve currency of the world. So this is a mega cycle, right? A super long-term cycle that's playing out, which, like I said, US has to be aware of what's going on and has to confront this issue at some point. But we can't take this mega cycle event and extrapolate into a very, very short time horizon. So so UNH, I'll go over that in just a minute. I'm just going to go over some of the comments here. So what's the catalyst? That was a Moody's downgrade. This is late. Imagine the current grade BB1. VIX is high. It's time to buy. It's his motto. Yes, correct. Thanks to Karthik, I bought like 15 stocks at his buy targets. Like he says, it's unbelievable how conservative his buy targets are, and people in Discord were still able to hit those. Talk about risk reward. Yeah, that's the whole point, right? Our way of investing is defense investing, right? We want to be here for the long term. And in Psychology of Money, Morgan Housel talks about this really well. Howard Marks talks about it really well, is that you want to be in the game. You want to stay in the game. You don't want to have external forces force you out of the game. Margin calls, not having the cash, not investing in what you know, like good high quality companies, overpaying for the stocks, right? So all these mistakes, what they do is they squeeze you out of the game, right? They blow you out of the water very quickly. So the key ingredient to long-term success is survival. And it's hard. Survival is hard in the market because when you've got millions of traders, investors trying to take each other's lunch, it's difficult to survive in the market. And so that's the key ingredient. Warren Buffett, the reason why he's so successful is because he's been able to survive for over 6 decades, 60 years of investing experience. He's been doing it for a long time. So everyone's goal should really be to have a way of defense investing, survival in the game, so that eventually the odds are in our favor to capitalize on those opportunities. So that's why we go in with a conservative mindset. And as I've said this many times before, I'd rather be conservative and right than be aggressive and wrong. Because if you're aggressive and wrong, it's done. Conservative right is the approach, in my personal opinion. Okay, let's see. There's so many new investors that are new to the market, and whales are loving it. Just wait until they are done with them. It's all going to collapse 2 to 3 times. Yeah, I mean, again, there's always going to be something to worry about, something to predict that, okay, markets are going lower. But if you just zoom out and you look at markets averages, 72% of the times we've gone up. You know, why do you think bulls make more money than bears? It's in the stats. It's literally in the numbers. You study the numbers, you understand the truth. Why do you think that, you know, Buffett is more successful than Michael Burry, right? Because of their strategies. One is optimistic. You know, he's famously quoted saying, "Never bet against the U.S." However, that's changed a little bit, right? Like I said, new market dynamics, new environments. Just because it's worked in the past does not mean it's going to work in the future. So we as investors have to be aware of the changing market dynamics and then make decisions accordingly. So, but of course, long term, you know, markets have gone up. Is that going to continue? Nobody knows. But that's exactly why we have to be on the pulse of the market and see what's going on. Okay, so very quickly, I'm going to break down UNH. I know a lot of you guys have been asking for it, but in one condition. I'm going to break down the technicals. In one condition, if you guys drop a like on this stream. We got 130 likes right now with over 700 people watching. And I'm confident that a lot of you want me to go over UNH. I'm going to go over the technicals, but only if you drop the like button. And if we get up to over 200 likes, I would really appreciate that. And let's talk about UNH. So I do have my technicals here. And we've got a gap that we're filling in. 6% higher on Friday. Very strong. Probably one of the only names right now. Very few names that's actually pushing up pre-market. Most of the market is down on this downgrade, but UNH getting a nice little rebound here after absolute bloodbaths week after week. So last week it was down 23%. The week of April 14th, it was down 24%. So incredible amount of selling pressure. Now, valuation has certainly come down to some insanely low levels. I mean, we're talking about a stock that's now trading at 11.5 times earnings, under 1 time sales, and over 8 times cash flow. And earnings expectations are for a decline in 2025, but then of course forecasted to start increasing once again all the way through 2028. So I do believe that UNH is still a strong company worth looking into because of the cheap valuation that it's trading at, significant overreaction, incredible amount of oversold conditions here. Let's take a look at the balance sheet here. We're talking about just over $50 billion in debt, net debt right now for the business. So support level for UNH at $300. I mentioned this in our Discord as well that I could see UNH going down to $299, $300. Of course, we took out $299. We came down to $248 with this massive gap down. In the last couple of days, of course, so much volatility. So we do have this gap that UNH may or may not fill eventually. And right now we've got a support roughly at $300 and a resistance all the way up to $378 for UNH. But, you know, long story short, I do like this company. Cheap valuation, earnings expected to grow over the next 3 years after 2025. And balance sheet is not ideal. I mean, we ideally look for companies that have, you know, more cash than debt, or ideally as much cash as debt. The company does have a lot of debt on the balance sheet. But all things considered, this is a deep value opportunity here for UNH. Okay, let's see. Let's go over to the markets, see where we're at. I'm wearing my red t-shirt today to welcome this market sell-off and welcome these opportunities once again. Just quickly, I'm going to be looking at SoFi and Nvidia as potential CSPs today. So for cash secured puts, I'm looking at SoFi. It's down almost 4%. And then we'll be looking at Nvidia for cash secured puts as well. It's down another 2.5% right now, back under 132. I do have the 140 calls for Nvidia, so that's good. That is actually rolling over once again, because it allows me to keep my shares, and of course the 140 call gets further out of the money. So support level 127, I don't mind picking up more shares. I'm trying to wrap up my Nvidia position to 1,000 shares, so I'm only going to be selling one put. It's not going to be moving my cost basis all that much. So 127 is going to be a strike price that I'll be looking into, possibly even 118, depending on the premiums and what we get today. And then for SoFi, I'm going to be looking at roughly around 12, maybe 1250, depending on the premiums, like I said, after the market's open. So that's it for everyone. You guys, thank you so much for joining. I really, really appreciate all of you. And again, if you want to get access to our Discord, members only videos, everything, link's going to be down below. I will share the link for this with everyone in the Discord. If you want to join, I just posted my week number 20 options portfolio update that goes over all my positions, literally everything that I have in the options portfolio with my actual shares, cost basis, performance summary, total profit loss statement. Everything is discussed in that video. And so you can follow the journey of that portfolio on there as well. So thank you so much for joining. Really appreciate you all. This is the liquidity framework. Last thing before I go is something that I've shared before with everyone on Discord and YouTube as well. And this is, I think, a good way to navigate the current market environment as well. Because if you're looking at a market that is optimistic right now, so we're over 3.8, so we're somewhere here, that's when we are, or at least I will be in preparation, meaning that my cash as a percentage of liquid portfolio is going to be 20 to 30%. Right now I'm at 15%, just under 15%. So I'll be looking at, raising more cash and then selling some puts, considering this gap down and of course a new round of potential selling pressure in the market. So this gives you a bit of an idea on, how much cash to actually have, how to prepare yourself, because the lower the money invest index is, the better the deals. And so less the cash I have in my portfolio because I'm deploying it into the market and I'm actually buying. But the higher the money invest index is, that means we are at overbought levels. We are at technical levels where a pullback or a correction could happen any day now. Volatility is extremely low. So that's the time to actually be prepared with more cash on hand. And, this is exactly what Warren Buffett's also done. Like, he increases and decreases his cash exposure as there are opportunities and as there aren't. So that's what he does. He's kind of play around with the cash exposure in the portfolio as well. So thank you so much, everyone. Happy investing. I will see you all in our Discord. If you're a part of it, I will share my updates and alerts there. And again, if you can reach out to me if you have any questions, we got a lot of other members, super experienced and helpful community to help you in your trading and investing journey. So again, if you have any questions, please feel free to reach out. Happy investing. Have a great Monday.